The venture capital sector has suffered notably from the change in economic environment over the last 2.5 years. Following a period of significant flows of capital being raised and deployed by private equity investors when interest rates were near zero and the cost of capital was far lower, this segment has felt the full force of the shift in sentiment as we experience one of the steepest periods of rising interest rates in history and the subsequent impact this has had on funding and the workings of primary capital markets. However, notwithstanding this challenging period, there remains an important and persistent trend of businesses choosing to stay private for longer. Data from the Venture Capital Initiative within Stanford shows how the median age of VC-backed technology companies at the point of IPO has more than doubled from 6 years back in the 1980s to over 12 years today. Many modern-day digital businesses no longer need the large cash injection from secondary markets, such as that used for the physical expansion of shops or marketing, nor do many entrepreneurial founders want the quarter-by-quarter public market scrutiny on short-term revenues and earnings, potentially disrupting their longer-term ambitions. The result of this trend is that a greater share of wealth is being generated by private investors before companies list. And this is one of the primary reasons why we believe investors should not ignore this investment category. And so in today's episode, we speak to the CEO of one of the largest listed VC investment companies in Europe, Martin Davis at Molten Ventures. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killick.com. In this episode, we were joined by Martin Davis, the Chief Executive Officer of Molten Ventures. Martin was appointed as the CEO of the then Draper Esprit back in 2019, prior to the rebrand of that business to Molten Ventures in 2021. Martin has well over 20 years of experience within financial services. He joined Molten Ventures from Aegon Asset Management, where he was head of Europe, and prior to that he held notable CEO positions at both Kames Capital and Cofunds. Molten Ventures was founded in 2006 and is one of the largest listed venture capital investment companies in Europe. The business aims to invest in disruptive, high-growth companies with strong intellectual property and powerful technology, enabling them to operate and grow into new markets. In our opinion, the listed fixed pool structure, such as this of this company, is a good fit for investment in private assets. Many other fund structures investing in private equity or venture capital will typically have a fixed investment period, before which they'll look to realise investments and are incentivised on the success of such exits. The Molten Ventures management team can employ a far longer-term investment approach without the demands of returning capital to investors within a predetermined timeframe. They can implement a strategy focused solely on maximising returns for each of their individual investments. Portfolio realisations can be made at the most opportune time and via the most advantageous route. Molten's multi-stage platform, which we discussed briefly in this interview, also enables the ability to invest across a variety of stages of a company's life cycle, with further capital being provided once a greater conviction is gained in an investment. This provides a level of risk mitigation for earlier stage investments, often carried out via separate managed funds, which can also feed management fees back up to the PLC. Against the highly challenging market environment experienced over the last 3 years, the company's shares have derated notably, pricing in the expectation of a far more severe valuation fall from the portfolio than expressed in the net asset value decline over this period. The shares currently trade on a discount well in excess of 40%. Much of the underlying value of the company is attributed to the core portfolio, a group of 20 more established businesses which in the vast majority of cases are developing already successful products and services. Sentiment towards the VC sector will undoubtedly continue to be buffeted around by the macro and its influence on the funding environment. The failure rate of lower quality businesses will clearly rise and be accelerated in this new economic regime. However, for longer term investors, ultimately returns will be a function of the ability of these businesses and others which will undoubtedly emerge to successfully implement their business models and exploit the large addressable markets they are targeting. The underlying Molten Ventures portfolio contains a wide array of differing technology-enabled businesses. Enterprise technology and business-to-business services make up a majority allocation. These are facilitators and beneficiaries of technological innovation in a commercial, industrial, and healthcare setting, and look set to benefit from a long runway of businesses looking to automate and digitalize business operations in order to create efficiencies. We view this as a feature of corporate strategy, which we see as remaining of high priority for the foreseeable future. Martin, good afternoon. Thank you so much for sparing some time. How are you doing today?
Not bad at all. Thanks, Gordon.
So we've got a kind of standard opening question to these discussions. And it attempts to get a bit of a kind of insight into you, really, or maybe something you've been working on. So I wondered if there was an anecdote from a recent meeting or kind of an article or book that you've read that you can maybe share, anything kind of interesting going on your side?
Well, I was actually thinking the other day, and it's something that everyone talks about this period of unprecedented change. And of course, it's unprecedented because it keeps happening. Therefore, it's not unprecedented. But also around technology and the impact technology can have, and as a technology investor, something that's very important to us. And I remember years ago, in the context of some technological change, hearing about this thing called Amara's Law. And Amara's Law is a fascinating law. And what it says is basically people will tend to overestimate the short-term impact of technology, but they underestimate the long-term impact of technology. And I think when you look at what's going on at the moment, I think Amara's Law is absolutely what this is all about. Whether you look at AI or cloud computing or the Magnificent Seven dominating the US stock market, I think everyone gets so excited about this stuff because quite often they overestimate what's going to happen. And you go through this massive exciting, this peak of excitement, but then you go into the trough of disillusionment when you realize actually the world doesn't change overnight. It takes time. And then everyone forgets about it and thinks, oh, it's never going to happen. And then all of a sudden you wake up one day and you look back and think the world's in an entirely different place as a result of this technology, whether it's mobile phones, mobile computing. And I think when you look at the stuff that we're faced today in investing in technology, it's moving so fast. There's so much exciting stuff going on that, keeping this idea of Amara's Law, which is, don't overestimate how quickly things will happen, because that's dangerous, but don't underestimate the long-term impact. And I think if we look at investing in tech, and I think if you look at where we are as a society, the way we're changing, I think some of the technological innovations that are going on now are going to have a transformational impact on us. And I'm always reminded of Amara's Law when we have these bubbles of things like AI, and it's something we debate a lot.
Yeah, no, very interesting. Yeah, lots of read across to the behavioural finance of herding into things and then underestimating what will actually happen. Yeah, no, very interesting.
Well, markets driven by fear and greed.
Yeah,
this is from one to the other quite quickly.
Yeah.
And at the moment, people are kind of not sure if they're in fear yet, or they're still in fear, but they can move to greed very quickly. And it's that tipping point that drives a lot of our markets.
So, Martin, in some of your kind of recent commentary, you've kind of talked about that kind of stabilization in the kind of market environment for VC in Europe over the more recent period, whether it's that kind of stabilization in interest rate policy or some activity in kind of capital raising and IPOs and that sort of thing. I wondered if I could ask you to maybe talk through kind of how you're seeing the broader kind of European VC market at the moment, and kind of those signs of improvement that you're kind of pointing to there.
Yeah, I think what we're seeing is we are definitely seeing, as you allude to there, improvement in the macro environment, and macro factors are driving a lot of what's happening in certainly listed VC. We're not really seeing that come through to the VC market yet. So you're absolutely right. The long-term view of the cost of capital stabilized. Looks like everyone believes it's coming down. Haven't actually seen that yet, but the horizon seems to be getting closer on that one, particularly here in the UK. And I think so. Therefore, as the cost of capital starts to come down, and certainly the risk-free rate starts to come down, then inevitably people will change their approach to risk, and that will have a big impact. I think where we in the VC sector, because we operate this kind of and liquidity in the VC sector, because we operate this sort of virtuous, but some call it a vicious circle, where you have people make capital commitments, they deploy capital, they get realizations, they then use those realizations to meet their forward ongoing capital requirements. That circle has been disrupted by the fact that cost of capital's gone up and realizations aren't happening, and therefore there's no liquidity. And so that's causing a real a blockage in the VC market across Europe. Now, I think there are signs that it will start to become unblocked, but liquidity is still tough. So businesses that could get funded 3 years ago are struggling to get funded now. Top tier businesses, no problem, but anything below absolute top tier is struggling to get funded, and that causes a blockage in the VC market and puts pressure across the board. So much as we're seeing encouraging macro factors, at a VC level, we haven't seen a huge amount of change quite yet.
Yeah, thanks for kind of laying out that broad market backdrop. But I mean, I guess despite that, we have seen some notable recent activity within the Molten portfolio itself this year, and evidence of some positive signs with regards to exits and successful capital raising completed. And when I mention that, I mean the likes of Graphcore, Perkbox, and Endomag this year. Could I ask you to maybe talk through some of the developments that you've seen within the actual portfolio?
Yeah, so despite my previous comment around the market overall not seeing much liquidity, we've been working really for the last 2 years when we entered this stage of the cycle in running a very diligent and rigorous portfolio management approach to exits, and we are starting to see the fruits of our labours coming through now. And so actually we announced that we believe that we will see 100 million of realizations through this financial year, in an environment where, as I said earlier on, there's very little liquidity, very few transactions going through. I think that's very much at the front end of the wave of exits. So for us, we're exiting at the right time and at the right price, all at or above NAV, which is important for us. And so really the exits that you're referring to, Graphcore, Perkbox, and indeed Endomag, are all deals that we've been really working on for the last couple of years. They're not sadly any indication that there's a switch has been flicked. They're deals we've been working on for some time. It's the right time for those businesses for different reasons. And I think what we're finding now is that macro starts to change. Those deals have been sitting there getting warmer and warmer and warmer, and we're able to get a few of them over the line now just because that medium-term view has improved. I don't think that necessarily means that we're going to see a a broader flood of realizations coming through. But I think what it does mean is that, rigorous, disciplined portfolio management will start to see results now, whereas a year, 2 years ago, kind of didn't matter what you could do unless you were willing to slash the price. You weren't seeing realizations. And so I think it's more a reflection on that kind of longer term, rigorous approach to portfolio management more than anything else. But it's really encouraging to see them come through and to come to fruition, and for us to be able to exit at or around NAV carrying value.
Yeah, that discussion on cash realizations is perhaps a good lead into talking about capital allocation, if I may. Could I ask you to just provide a bit of an update on the approach that you're taking, both at the Molten company level regarding the kind of uses of capital at the moment, and also it'd be interesting perhaps on an update on, I know you've done a lot of work with underlying companies with regards to prioritizing certain aspects of capital allocation and making sure those kind of cash runways are in place to get businesses through the kind of next phase. Could I ask you to touch on both those points?
Yeah. So inevitably, when you start talking about realizations, more capital coming in, then that poses the question, and which is why we made it clear to shareholders in our trading statement, and then followed up with our annual results in June, that with this money coming in, that we need to be more explicit about our capital allocation, particularly around question we've been getting a lot of shareholders around buybacks, and allocating some of the capital coming back in to support share price. So that's something that we announced that we'd be doing. In fact, we have a very defined waterfall of capital allocation, where we define each block of capital that comes in. The first block to broadly ensure that we maintain our own liquidity position and have, in the same way that it's important for us to take the medicine that we're giving to our portfolio companies, that they need visibility on 12 to 18 months cash. So we're making sure that we have that liquidity within our own business to make sure we can pay our bills out to 12, 18 months. So that's our first requirement. The next requirement then is we are an investment business. We need to find the best investment opportunities. So we should be topping up those investment pots where we can deploy more capital. We've got our own portfolio to support, so we want to be able to put more money into the portfolio. And indeed, we want to be able to support the share price. So we have a waterfall as cash comes in for how we would deploy that. And over the 100 million that we're looking to come in, we think about 10% of that should go into share buybacks to support the share price. And that leaves the other 90 for us to be able to either deploy that or to hold it as on the balance sheet, to be able to ensure that we have 18 months runway in our own to meet our own commitments. So that's kind of how we look at our allocation. And I think it's probably worth a little bit, I might be stealing a question I guess you might be asking in a few minutes, is that, where are those investment opportunities? Because I think that is something that's changing quite a bit. And what we're seeing is that there are still direct investment opportunities. And so we do have a pot for those direct investments, but we're seeing much more opportunity in secondary markets. And so that's secondary markets and follow-on, where we know the companies very well, and we want to take a bigger slice of the best companies that we already own. And so I think as we allocate that investment capital, we will be weighting that more towards secondary deals, more towards the companies we own, and slightly less into new proprietary deals.
Martin, could I bring the conversation back onto those kind of big technological themes that are underway at the moment? And clearly, artificial intelligence and machine learning have been around for many years, and you've been talking about them with regards to many of the portfolio companies for a long time now. But I guess the proliferation of Gen AI applications has clearly expanded notably over the last couple of years. And you can see the potential it has to disrupt most traditional business models at the moment, as well as kind of consumer behavior and working practices. Could I ask you to maybe kind of talk us through how you see the Molten portfolio kind of evolving over time against that backdrop, and also whether you've kind of adapted any of your own kind of investment process or investment themes against that kind of changing backdrop of innovation?
Yeah, so I think we have we're not an entirely typical venture house in that we invest in businesses that are scaling quickly. We invest in businesses that are good businesses, so they have to be able to generate revenue and ultimately at a high margin and grow rapidly. So we want well-run commercial businesses. They tend to be enterprise software. They tend to be infrastructure in their nature. And so I kind of come back with AI to my opening comments about Amara's Law, in that it's very important for us to avoid tech bubbles, because that's not where we're looking to make our return. And so therefore I think AI I think a lot of people are overestimating the very short-term impact of AI, certainly when it comes to investment. It's very hard to see exactly where there's going to be money made quickly in AI, but I think it's also very dangerous to ignore the long-term impacts of AI, because Gen AI will affect every solitary business in a period of time. Without a question of a doubt, every solitary business, in the same way that every business uses spreadsheets and word processors and computers, every business will use Gen AI at a time in the future. And so therefore our strategy is to look at where AI can build and drive and disrupt, revenue generating businesses. And so that's really where we're making changes. So we had a company in quite recently that we were looking at that was using AI to be able to help generate sales leads. But it is interesting because that they weren't selling software. They're selling effectively, what they call humanoids. So effectively, it's a person. It's like as much as possible about a salesperson. It just happens to be a machine, and it's not about software. It's about replacing people with real productivity. And I think that's a really interesting model, because what that means is that when people are looking at buying, they're not saying how much does software cost. They're saying how much can that person make me or save me or generate for me, and that's what drives the buying decision. And that's where we think Gen AI is going to be really interesting. And it's not about turning everyone into robots. It's about increasing productivity, increasing efficiency. And that's where we see where we see Gen AI really driving efficiency or productivity, that's where we see the real opportunities. And I don't think it's changing our investment thesis that much. We want businesses that want to pay for that capability now, not that might pay for it in 5 years' time. And I think that's really where our focus is. It means that we're not generally in pure play, what you might call pure play, full stack AI businesses. We don't generally invest in those. But what we do invest in is businesses that are using Gen AI to disrupt existing business models. And I think that's where we see the real opportunity. And to be honest, look, we invest in technology, and we invest in founders and disruptors. And any disruptor today looking to disrupt, a supply chain, a value chain, they're all looking at how Gen AI can help them. And so it works right the way through our entire portfolio.
Martin, if I may add two final questions. And one of them I really wanted to touch on the kind of the multi-stage platform, and I wondered if I could ask you to talk through the advantages of having that kind of really early stage part of things as well as the kind of core portfolio. And I know a lot of the kind of really emerging ideas, you get a lot of visibility through that early stage piece as well. But I wondered if I could ask you to kind of talk through the advantages of that model, particularly as we kind of go through an economic cycle like we have done.
Yeah, no, look, absolutely. And I think the multi-stage platform is particularly important as we go into the next stage of the cycle. As I said before, only the best companies are getting funded right now, and therefore you have to be in early because it's so competitive to get into the top companies. It is so competitive, as competitive now as it's ever been. You can get into the tier 2 and tier 3 easily, and they used to be competitive 2 years ago, 3 years ago. They're not anymore. But to get in the top tier is just as competitive as it's always been. In order to do that, you've got to get to them early. Now, if you are a very large American fund and you've got as much capital as you like, and you can spray it around and you're not too worried about valuations, then you can kind of survive that way. And a lot of them do. And a lot of the top tier firms get funded that way. And we're seeing a bit of that going on even in the current environment. But if you want to get in the best businesses, well priced, at the right level with the right stake, you've got to get close to them early. And so therefore, our multi-stage platform is about making sure that those the best seed funded assets, we're already in and we already have that visibility. And then when those early stage post-seed investments, which is still earlier than us generally, while they're still proving their model, they're still proving their revenue, they're probably pre-revenue, proving the technology, for the best ones, we want to put in a bit more of the stake, build our stake, and stay close to the founders. Because when they break out and they turn into that top tier business, which is when we would traditionally invest, that's when they go from having no friends to having too many friends. And that's when, if we're not in there at that early stage, then we run the risk of either not winning the deal or having to face a ridiculous valuation debate because someone's come in late and they're spraying cash around. So that's really why the multi-stage platform is so important for us.
Martin, our final question is another standard question, actually. It asks the speaker to pick their kind of highest conviction area at the minute. And I don't want to kind of force you to pick a single company, but I wondered if there was maybe one kind of single sector or area that you are particularly excited about on a certain time frame. If there was one area that you would pick out there.
Yeah, and I'm glad you didn't ask me to pick out a particular company, because obviously we love all of our children, equally. But I think, I think there are a couple of things that we're definitely seeing a lot of capital being drawn to and a lot of potential for future investment. That'll come as no surprise. Space is one that's a lot of activity at the moment. Health and climate. Those are the kind of, when I say health, I mean, specifically digital health. And I think those are all areas that we find interesting. I think what I would say though, and we invest in all of those areas, I would say rather than pick out one of those, I'll come back to what I was saying earlier on, which is, which of the capabilities within those verticals are going to be particularly streamlined by the application of Gen AI. And I think that's where we're seeing, real advances. In the same way that 5 or 6 years ago, it was those businesses that are being driven by computing power that was growing very, very rapidly. That it was those businesses that were going to be propelled by cloud computing and the SaaS model, and they had a period. I think it is Gen AI is the next one. And again, just to be clear, it's not full stack Gen AI. It's where the AI capabilities can drive change and drive innovation that delivers real productivity and efficiency gains, particularly for us, for infrastructure and enterprise, because that's where we see the real opportunity. And I think you could pull out different subsectors of health or climate. I think energy transit, data management in energy transition, managing that data as we go through energy transition for climate. I think that's really important. And again, Gen AI, what you can do with that data, it transforms its ability. And I think people are starting to look at these models through a completely different lens than how they were looking 3 years ago, just because of that capability. And so for us, what we're really interested in seeing is, okay, how can you generate real value and generate income. And as I say, I'll come back to my point right from the beginning. Someone has to be willing to put their hand in their pocket and pay for this benefit. It's not, we all love ChatGPT, and we all love the idea that it might help our kids cheat in their exams, et cetera, et cetera. But what are people going to put their hand in their pocket and pay good recurring revenue year over year over year for that capability? And what are the problems they're solving? And I think that's where we get into the nuts of what we're investing in, and that's where we probably get most excited when we look at companies at the moment.
Yeah, no, some really important points in there. Yeah, no, thank you very much. Martin, it's always really interesting to chat to you. Thank you so much for joining us today.
My pleasure.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com. For more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.